Hello traders, it's 12:01 p.m. Chicago time on Thursday the 12th of May 2022. We're here today for our study hall session. We're going to talk about icebergs and collisions. In addition to what I'm covering today, we do have Tendex on, who also looks at icebergs, and you may have noticed that he often points those out in the Head Trader channel. I want to remind you that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Here's what we're covering today real quick. This shouldn't be a long session. There's only so much we can say about icebergs and collisions. We're going to define what icebergs and collisions are so everybody knows. We want to be clear about the time frame that is in play. So I don't want to mislead anyone into thinking that you can just build a trading plan around this unless you plan on being a very active scalper type. We're going to talk about the significance of icebergs in market action and execution. What do they tell us? Why do we care? How collisions come into play and the reaction that follows. And we're going to look at some market examples just from today's action. We'll show like some collisions. Didn't see really that many significant icebergs today, but I'm also not 100%. My head's not 100% in the market. I believe Tendex, you pointed one out earlier at some point, and we can go find it. Let me see. I think you might have pointed one out, but I'm not sure.
Yeah, it was in pre-market, so we can go over it in a little.
Okay. So let's dig in here. What are iceberg orders? Iceberg orders are simply large hidden algorithmic orders that are shown as a small amount that keeps replenishing until the entire block is filled. So when I used to work on trading systems a while ago, one of the ways that we executed like a 1500 lot in the trading system is to show 5 contracts, and as soon as the queue brings that 5 contracts up, as soon as it's filled, 5 more in like 1 millisecond on a co-located machine, or even less, nanoseconds sometimes, another 5 lot will pop in, and we can execute an entire 1500 lot block at one price. If the market demand is there, it has to keep trading, it has to keep filling for it to come in, and every time you add, the next block goes to the back of the line. I've seen icebergs in this market that are trading 1 lots. You see like a 1 lot come in and get traded and again and again and again. So what an iceberg is it's a large hidden order. It's a way for a market participant to minimize slippage and get filled on a large order without tipping their hand or showing us that they have a large order to fill. There's no evidence of an iceberg prior to the market trading that price. So we don't really know where they are because they haven't been entered into the system. The algorithm enters them as they are needed. Collisions, on the other hand, are completely different. For some reason, sometimes I hear speakers conflate these two. Collisions are generally large resting orders. Sometimes they can be icebergs, but generally they are large resting orders, and we could see them on a heat map or in a DOM, and they stay steady. They're either a bid or an offer that the market just moves to and then nibbles on and may collide with, meaning it just goes and it tries to lift it or does lift it, and it just takes, you know, the large prints. Oftentimes the large prints, if they are not market orders, on the demand side, large orders are generally filled through collisions. Collisions show us the true intent and actual execution of a large block. Collision orders tend to get larger or remain the same as the inside market approaches. In other words, as you know, there are a lot of spoofers in the market. There are orders that keep popping in and out, but when I'm anticipating a collision, generally I'm seeing that the size is actually growing as the market is coming to it. It's not backing off. Whereas a lot of the spoofy stuff, as the market moves up, the orders get thinner until they trade at that price. So there's a significant difference between collisions and icebergs here. Both are order flow features. Let's be clear about the time frame in play. Really, this entire discussion is based on a very short on a very short term or execution time frame. So the time frame we're talking about is really short term. This doesn't mean that this information is useless to you unless you're a highly active scalper. That's not the point here. But at the execution level, icebergs do make a difference. I really pay attention to what that is. And there are guys out there who teach how to trade using icebergs and stop runs and collisions and things like that, but those are more scalpy type environments. So this information needs to be understood in the framework of I'm about to execute and I'm looking for artifacts or certain features in the order book or in the market in order to execute against. Nothing shared here is intended to stand on its own as a trading plan or way to trade. Trading based on order flow only is generally done by scalpers and other more active traders. But this information is still useful because it helps us refine, it can help us refine our execution. The significance of icebergs in market action and execution. Icebergs really provide a real-time indication of buying or selling interest at a price. So we come up to a price. We've seen these heavy at the century figure. We've seen these very, very heavy at the mid-century figures. And they have left us with a profile that has a big ledge in it or some weird deformation in the profile because, you know, we come up to these, the last significant one that we had was at 40.50, for example. And you know, it's just the market comes up and it trades and it trades and it trades and it trades and it backs off and it trades and it trades at that price, can't break through, and it just creates this like flat top on the profile, and that's an iceberg. Eventually, icebergs, you know, it's a block, so it could be 10,000, 20,000 contracts. Eventually, the market has a lot of pressure to the upside if it's offered. You know, let's say at 39.50 offered, which we'll look at that in a minute. You know, the market eventually has enough pressure to push through that iceberg, and that provides us with information as well. So pairing this information with context can provide a significant edge when that price gets broken or revisited. One of the things, and maybe Tendex will talk about how he looks at it, but one of the things I look at is like, I'm trying to find a place to get long. We're around an area that's fairly significant. My bias is long. And then we come up to an iceberg and we trade and trade and trade and trade and trade. And then we, you know, generally the last, as soon as the block is finished and it's not replenishing, generally there's a stop run through. Like yesterday, I put, just as an experiment, I put a stop order behind an iceberg, and I wanted to see how far it would get filled. And I think it was at 11 even, 40.11 even. And I got filled at 13.25. And I was late putting the stop. Stops are also cued by when you put it in, by time, first in, first out. But there was a significant push, and that trade was looking for a wide target, right? That's the trade that was looking for 25 as a target above. So that made sense. But, you know, if we have an iceberg and it finally breaks and it pulls back, I'm really monitoring for that location to hold. I see the flat top. I see there was a lot that took place there, and I expect that area to most likely be defended. And it creates an area where you can quickly take a trade, cover risk, and then if it goes, it goes. If it doesn't, then your risk is covered and it just didn't work. So icebergs often leave a mark on the profile and can even shift the point of control in a session. So we've had this happen recently, last Friday, for example. where it's just, the point of control is in this nice distribution, and you have a point of control somewhere within that distribution, and we go and trade a lot at a specific price. We create this big flat ledge, and then the point of control shifts to that price, creating what I would call a distorted profile. It's an unnatural profile. So that's how big they can get. We want to pay attention to iceberg prices, as they may solicit a reaction from the trapped longs or shorts in that area. That's what I was talking about. I'm always watching for, okay, how does it react once it goes back to that iceberg location? It doesn't always mean that there's a trade there or something will happen in our favor, but it's an important feature that I'm paying attention to. How collisions come into play and the reaction that follows. Generally, collisions, not icebergs now, collisions offer a more transparent intent and action in the order flow. Like, we can see where certain participants or participant has come in and is just working an order, and they're staying steadfast at that location. And that generally creates, if they're above the price action, it generally creates, I've seen, for example, a collision, an area that starts as a collision, become the over-under line, and it becomes the top or bottom of a support resistance area. So these, a collision is just, people don't care. It's not like an iceberg. It is actually shown. The market trades it. It might pull back, it might break through, and then it acts as support for a continuation. I'll show you examples of that in a minute.
And I just to add something to that, like collisions and icebergs are not necessarily mutually exclusive either. They can be, but they can end up being one of the same. Like the visual part that you see in the DOM could be part of actually an even larger iceberg. And that's usually quite significant when that happens. So they don't have to be separate, but oftentimes they are as well.
Yes, that's true. And the reason I'm creating a separation, just to clarify, is these words are not interchangeable. They're related. They're both order flow features. But collisions are size, present, and getting hit, and you see a huge or an unusually large print. Like there's a big aggressor there.
I guess
you don't see.
The way that, sorry to interrupt, but the way that I would just phrase that concept that you're talking about is basically the visible versus invisible part.
Correct.
Like an iceberg is the invisible part, and the collision has to be visible. You have to actually see that in order for it to qualify as a collision in the book. And the iceberg is the part that's below the surface. And sometimes there's stuff below the surface, and other times there's not. You just hit a rock on the surface, and that's the end of it.
Right, exactly. And it gives us a fair amount of information when we get that artifact. How the markets how the market reacts following a collision is very important. So again, I'll show examples of that. We're going to look at a few examples, and I'm not trying to be exhaustive here. So I went and kind of made the big dots, the big trades on my heat map here a little more obvious. Not everything that has a big dot is necessarily a collision, because this is aggregating these orders. This is an MBO feed, and it's aggregating the orders, and it's showing me a big dot every time it surpasses a certain amount, okay? So what we're looking for is size. So let's get rid of the cloud levels here. Actually, let's hide them. And let's make the heat map a little more obvious. So it's going to reload here. And so I'm filtering out by the biggest size in the viewable area. So you see these weird yellow and whatever, but really all I'm paying attention to is these maroon. So this is a collision. You can see the size has been there quite a while at 24.75, and it you know, it's holding steady, holding steady, holding steady, and boom, somebody lifts with an aggregate of 118. You can see the 118 volume at 39.25. The fact that it's occurring at a 5-point interval, you know, it's very, very common in the ES, as it is down here at 15 and whatnot. But, you know, that's a collision right there. And I've highlighted, there's a lot of activity today, but I've highlighted some collisions and how they may respond. So here's some size sitting here on the bid. The market comes in and it collides, bounces off, collides, bounces off. And what I do in general is look for that area. This is not a significant one, but it shows like a market that's coming down, is trading and trading and trading, and it finally breaks through. And what we normally see is the market breaks, then it comes back to that area within a tick or two before the continuation. It's not a very good example, but I'll show you some more. So here's a decent one right here. Market comes down, comes into 39.06. You know, some hitting going on. You can see the delta is getting hit, some pretty good volume, and it gets into this collision, that this size that showed up. It was here, it went away, then it came back in, and it traded into it. By the way, where the dot is not necessarily where the trade happened. This is a VWAP of an accumulation of dots of sizes, but you can see it beat into this bid here, and you can see there's a black gap there. It basically filled what was there. Then it bounced back up, came back, consolidated, and you can see the reload. Somebody reloaded, different participant, whatever, and it breaks. It smashes into it again, smashes into it again and again and again, and it finally breaks through. And what I wanted to point out is, with collisions, this is what's significant to me. It's that little pullback. This is not a very, very good example, but it oftentimes creates a breakout pullback trade that is more scalpy in nature, but for me, it's also a better entry. It's an entry that tells me that something significant has happened, and what happens here is that you see that often. You'll see a collision take place. I don't have very good examples today, but hang on, I highlighted a few more. So you've got this size coming in here, a little bit of size, it trades, bounces through, breaks through, and then at some point later in the session, that price shows up again. So there's the size, it traded through here. I'm losing my dots here because I'm trying not to load so much information that I end up with dots everywhere. So I limit them to a couple hours. But you can see that we come back and there's that size yet again at 39.30, you know, again, settle. And it actually traded out here. And this area becomes kind of a chop show kind of area before it continues. For some reason, I did have some really clear examples, but
FT.
yeah.
Before you move on, there's a few questions that people are asking about this, and then I don't know if you want to take them.
Yeah, go ahead.
Is that
Here it is.
pullback area that FT is pointing out basically the imbalance left by that first red impulse bar down being filled? So it backfills test, and that's the entry?
The true answer is I have no idea what the intent is, and I never do. I just don't know. I just don't care in a way. Like we get a measure of comfort by being able to explain the action with logic. But what I noticed, and I noticed this a long time ago when I was working closely with Bookmap, and before the product even launched, I started to watch very closely what it does. And I noticed this kind of behavior that I've always seen within the order book just with my eyes watching the DOM for so long. But now the heat map gave me a very clear picture of how that works. And to answer your question, I don't know why. I don't know if it's excess supply. I don't know if it's people who stood, you know, if I had a gun to my head and I had to explain it, I would say it's people who who are looking for a short, leaned against the size that was there, and then it busted through, and now they're just trying to scratch or flatten the trade, and therefore they become support. So this is the example that I actually wanted to show you. The early test of 39.30, the settle. We come into 39.30, and we've got this relatively significant size sitting here. And we come in and we sweep with 102, we fill another 65, and we take out what was there, and we fall right off. So two things can happen with a collision: it smashes it, chops around a little bit, or breaks through, uses that as support and continues, or smashes it, turns the other way, and then it gets kind of weak. That's what it can do, and we don't know how it's going to respond, so we lean on context, we lean on bias to give us an idea to support our trade. Not that the market has to do what we think, but it supports our bias, right? So here's the collision, then the size comes right back in, and you see again, it comes right back. The size comes right back at the 39.30. It fights it again, higher pullback. Then it finally breaks through, and it gives you this little kind of flash here. See that little, it just kind of pulls back real quick before it continues. I see that very often. You have to be very quick to catch that. Very often this kind of occurs in 1 or 2 seconds. But this area following the collision, and because it's the prior settle and it's a, you know, it's a 39.30 or 39.35 or 39.40, it tends to attract, just like the 39.40 up here tends to attract size, because you know it's an option strike, it's a round figure. The 10 and the 5 handle are significant in pretty much all products, to be honest with you. I see a lot of action around those. But we come back and there it reloads, and then you have another collision, pull back again, and then we finally break away. And not to be outdone, you get this final kind of, you know, now we've got a lower low than where we retested earlier. We're putting in lower highs on a very short-term basis. Not to be outdone, it gives another opportunity. These are one of my favorite trades here. It gives another opportunity. See that breakthrough right here? Gives another opportunity within that collision zone, which we now know is significant because it's prior settle. It's, you know, it's a 10 handle figure. It had a bunch of collisions on it. There was a fight from top to bottom to top to bottom. It's a clear support resistance level locally in a very short-term basis. It's a clear support resistance level, and then you get this little let's give them another jab. This is where people who get short and then move their stop to break even get whacked before the move actually happens. And so if you have the ability to watch a heat map, if anything, at a minimum, it's interesting. And there are examples of this around the 39.10 from this morning. You look at the 39.10, and it has had size there pretty much the entire session. Look at that, 39.10, 39.10 over here, 39.10 collision, pullback, attempt to hold, break lower. You get stopped here. I've gotten stopped. I've had full stops a lot today, actually over the last week or so. But you can see the first test, divergent test of 39.10 results in a collision, but there isn't enough size here to give me a bubble. But this is size that got traded. Oh, there it is. This is size that got traded into, and it gives us a significant event that we see and can lean on in the order flow. So if I'm looking to get short the 39.10, I want to see what that size does. If it flushes through, it gives me a little more confidence, believe it or not, to get short once it flushes through and it starts to kind of fall back through. If we have size, let's see if we can see that in the order book now. So if we have size, like let's say right here, 3910, there's size there again. You could see that the size actually consists of a pretty significant block, looks like an 80 lot or so in there. But if I want to get short, a lot of people will offer that 3909.75, figuring that, you know, they can't get filled to 3910 because they're in the back of the line. So they get short here and they put their stop, you know, a couple ticks above it. And so it comes in and it takes it out. This stop run went to 11.25 right up here. What I like to see is this size sitting here. It comes up, and it fights, and it finally blows through. You know, there's a pretty decent lift, like a 80, 100, 150 lot, picks that up, fills it, flushes through. So now we get a quick little stop run. I like to catch a 39.10, so my cursor is on the short side, on the sell side, because my intent is to short that 39.10. My cursor's on the sell side, and I'm hitting on the way down as best as I can. Or I hit sell market as soon as I see it go through and start to hesitate. Where does it go through and not hesitate? It goes 39.10, 39.12, 11, 11, 11, 10.75, and then boom, it takes out that 12 and it starts going. That's when I know that this is a collision continuation versus a collision reversal. Now, last thing I want to say before I bring on Tendex to see if he can fill in the gaps that I've left behind. To develop an eye for this, it is really important to watch this a long time. It takes a significant amount of time of seeing the market do its thing in order to not get caught up in the noise. Dots all over the place, lots and lots of noise, lots and lots of noise, right? So you need to, you're not going to be able to sit down in a half hour, look at a few charts and be like, oh yeah, I get it. I can see exactly how this might help me execute. It looks like a mess of stuff. Kind of like somebody who's working at the post office and is being, you know, you get a big container of letters being dumped on them. It looks like a mess, but the person working there, having done it for a long time, can sort through the letters by using zip codes and then can sort through sections of that zip code and organize this information. It just takes time to develop that the capability. And that's one of the caveats and one of the problems with order flow is that people don't watch this stuff long enough to develop a feel. What do you have, Tendex? What have I missed?
So I think on that, just on that last point, I think there's also the risk that you will look at this stuff and it will make a lot of sense to you right away, and you will think, wow, I understand that. That's really simple. I get the concept. And then you try to apply it too early, and it's only through all that trial and error that you realize, oh crap, I can't just short every one of these heat map volume blocks or all these icebergs. I think that tends to be a really common problem because sometimes it's easy to grasp what a heat map means or what an iceberg means, but to actually understand it in the context of how to trade it, I think is a very different thing. So I just wanted to add that onto that last statement you were making about understanding this. It does take time to really grasp how to trade them. I think one of the most important things to realize about icebergs and collisions and why they are important to us as well as others is that they can give you very clear insight into the supply demand dynamic between the participants at that price and at that moment in time. And that's really important for us because we're always trying to gauge who has the upper hand here? Or like, are buyers in control or are sellers in control? And we do this through multiple ways, right? Like we'll do it through just watching a bar chart, just watching price action and just seeing like which way is it moving. Like sometimes it's extremely obvious that it's bullish and we're trending higher, or it's bearish and we're selling off. But we're always trying to do that in a way. We're always trying to gauge who's in control. And icebergs and collisions give us a way, even if you're not scalping against these kind of order flow phenomenon, they give us a way to gauge how the participants view the fairness of particular prices. And that's insightful because if we see a market push up to either a collision, visible, orders in the book. Let's say the market's going higher and it goes up and it hits one of those heat map collisions, or it goes up and it hits an iceberg, or it goes up and hits a collision, and then we see it's hitting an iceberg. Whatever it is, if we see the market going up to a price and it keeps knocking on it, right? And clearly, because we're seeing the iceberg, we're seeing like the orders fill up on the sell side, we're seeing the collision dots, whatever it is, that's telling us something about how many sellers are there. And that's the really important part, because if the market cannot push above that price because there's an overwhelming amount of sell side supply there, then price needs to react to that, which means it's going to go lower on odds wise, probabilistically wise, within our kind of time frame, it's likely to go lower. And vice versa,
Index
if they keep
right
if we
here,
push to a high.
right here. This 3980 right here. This bounce, push to
Yeah.
3900, fall through that little blip right there, creates a very short-term scalp. That doesn't mean I should trade it. I'm just saying if I'm looking to get short and I don't have a short on, this would be kind of the area I'm looking for. This is a market that has pushed through, has pulled back, and has given us an opportunity to get short. In this case, it's not working, but this is the kind of thing I'm looking for. This size goes to the other side, comes back down, breaks through, and I'm looking for it to kind of continue. In this case, yielding 4 points, which isn't much, but anyway, sorry. Go ahead.
And no, that's exactly the point. In fact, actually, when we were talking about earlier, one of the examples I pointed out, it was during RTH around 10:23 Eastern, so 9:23 Central, and it was on that push up the settlement. I don't know if you have a footprint up at all, like a volume scope that we can see. It makes it a little bit easier for me, but this is actually a good example of not a collision per se, but an iceberg. So this is like 9:23 Central, I guess it would be.
Let me give you this because you're used to this. Hang on.
Yeah. If we have the numbers, yeah, here we go.
Sorry, there was a question for you, and I'm just wondering if this is the trade. They say today, Tendix said passive sell ICE at 30, just a tick below settlement, watch for the squeeze higher. What would be an indication sign that the iceberg is failing? So is that the trade that you're talking about?
Yes, that's the trade I'm talking about. So if you actually look at that timestamp, you'll see that there's an iceberg there, because right there you see where you have that run there with the 614. Yeah, so first you get this print. This is 600 to the left underneath that 472 delta divergence at top. Yeah, so if you look at the prints, right, on the left and the right side, and you go back a bar or 2 bars, like, I mean, most of these numbers are like double digits or like low 100, right? But then when you look at that bar, that 472 delta that you see when we push up just one tick above into the settlement, you get 600 that prints on the offer. 600 relative to all the other prints that you're seeing. And this is why context matters, because these numbers change over time. But right now we're on a thinner tape. So 600 is a good 6 times the normal volume that you would see per price. That's telling you that there's an iceberg there on the offer. And if those sellers can't hold it down, then that tells you that the buy strength is is strong, and that gives you information about what side you want to lean to. And so what you have is you come off of that 611 initially, and then right when we get back up to it, look at that, it just sweeps through. That guy or guys who are sitting on the offer there, they just move it. And the market makers take advantage of this and it sweeps up. This is all HFT here. And it sweeps up until all the orders basically are elected that were still sitting there on the offer. And then you have those market makers who are HFTs who were really quick and were able to step out of the way and remove their offers and perhaps buy it right into that price. Now they're covering their profits. They're covering the profit that you see in that squeeze from the very top. And that's where you get that little pullback to the 61 bar that's right next to it. But then just look 3 bars over, where do we retrace to? We literally retrace exactly to where that iceberg was. And we know to some extent, we have good probability that buyers are in control. The people who were selling that are now stuck. And there's some strength to the upside. So we can use this information to lean on that level. And this doesn't even have to do with the scalp. This is more using this kind of information from an intraday swing perspective. We can use that information to determine a good location that we can lean on. And we have good rationale behind why we're getting long. And we have a reference of context there as well. And then that's basically where we're looking to enter. And that's the kind of information to where, like, maybe you're not involved in the initial scalping opportunity that was there from the first touch, but you are involved in kind of like marking off these levels as an intraday swing trader to say, you know what, this is where the supply demand was imbalanced previously. And therefore, if I make the assumption that maybe that imbalance will hold, this is a good location for me to initiate a trade from. And I'm wrong if it pushes through a certain number of points or what have you. And that's, in my opinion, is a very valuable way to use these kind of collisions, or icebergs for that matter, as an intraday swing trader. And then there's a whole, other assortment of tools for like a scalper looking at these things, but that's a somewhat slightly different game.
How much time are you spending staring at the footprint versus the DOM and your foot PNF chart and so on? How are you scanning for these? Because these happen very quickly these days.
I think it's really important to not really be looking at this if you're not scalping, right? Which most people are not. I think your primary focus should not be on watching or looking for these order flow events. I think, and I don't spend my time sitting there waiting to find an iceberg. What I'm doing, and you'll often see this because I will post basically what I'm thinking is going to happen before it even gets there. And the only way that I'm doing that, I'm not seeing, icebergs before they happen or anything. I'm looking at the bar chart. I'm just looking at the context and saying, you know what, the settlement here was resistance before, so if it gets through, I think it will go from resistance to support, and then I'm going to lean on that to get long. That's, once I have that scenario outlined, then that's when, as it's approaching that level, that's when I'm tuned into the footprint, and I'm watching the orders as they go in to that price or that area. So I'm not trying to guess where these icebergs and things are going to happen. I'm just sitting there watching it because that's the area that I want to engage in. And then when I see that phenomenon occur at an area that I was anticipating it to occur, that just gives me the confidence to be able to pull the trigger. So I think majority of the time you should be focused on the bigger picture levels and the context in the bar chart, and then you only really zoom in when it's getting to those levels that you had pre-identified.
Okay, very cool. Do we have any questions, Yoda, if you're still here?
Yeah, there's 2 questions on that for Tendex. The first one is, Tendex, do you use limit orders to get long here, or do you just hit the market?
I think it depends. It really depends on the context and the location and the type of day that we're in. I mean, if we're in like a really strong trending day, and I have a pretty good, clear idea of where I think that line is that I want to get long or short against. I usually will just put an order in, like a passive order against that line in a market that's like that. But in a market that's more wishy-washy, like it is this morning, then maybe I'm waiting. Like I'm not going to put that limit order or passive order in. And that example that we just talked about at 10:23 Eastern is a really good example of where you don't need to get into it right away, right? You get that sweep that pushes through, and now it's like that 31s are key. So now you're saying, you know what, I'm going to put my order at 31, 31.50, 32, whatever it is, somewhere there, because you actually have saw the action unfold already. You saw that big sweep through. You saw the iceberg that was there before. You identified 31 as a really key level in the settlement before even any of that happened. Now you're saying, you know what, if it retraces back after this event, I just want to get filled there. So that's the kind of instance where I just put a passive order in there. You're not trying to chase it or anything, and it comes back. And oftentimes you'll be surprised, like it fills it literally like almost to the tick. And like this was a perfect case. I mean, it went to 30.75. So I don't think you can make a blanket statement on that, which way, how you trade it, how I trade it personally. Because sometimes I'll use, if I'm expecting a breakout before a level, I'll use a market stop entry order, so that when it's pushing up with that momentum, it fills me, and it also blows through my key level that I want it to go through. And now I've got a little bit better of an entry price than trying to get it right on the level. So I've given myself a little bit of buffer room, and I'm not chasing after it. And especially if you get a nice little sweep, then you've got good protection.
Okay. Next question. What would be an indication sign that the iceberg is failing? Simply put, is there a way to know when it's resistance / support versus someone getting trapped?
So in my opinion, you don't know ahead of time whether it's going to fail or not. You're always going to be, and as your job is as a trader, you're always going to be accepting risk. There's always going to be that uncertainty there. Some clues in my experience that an iceberg is more likely to fail, and to fail in a way that's going to keep continuing going higher, so it will just keep squeezing, is that kind of concept that we always usually talk about with regards to references, like multiple touches into a level and retracements off of that level. Like let's say you run up to an iceberg, you hit it once, you come off. You run up to an iceberg again the second time, you hit it, you come off. Then you run up to the iceberg a third time. Just the fact that you keep running up to the iceberg makes it more likely that it's going to fail. If the retracements that come off of that resistance are also weak, that's telling you that the buyers are still there as well in sufficient size. And you could flip this to the sell side if you're looking at it the other way. And that usually increases the odds that the iceberg is also not going to hold. But sometimes this kind of thing might keep you from, you won't necessarily, it looks like it's high odds that the iceberg is going to fail. But so you don't take a trade against the iceberg. But some of the best trades can happen when it looks like it's really high odds that the iceberg is going to fail, right? We hit it 3 times and we go up to it a 4th time. And it does fail, but it fails in such a way that it just pushes through by a point or 2 points. It looks like complete exhaustion, then falls right back below the iceberg. That sometimes is one of the best trades, because where you're wrong is really clear now. It's above wherever the iceberg had exhausted itself. And it tells you a lot about the buyers just don't have it there. There's just not enough buyers to overwhelm the supply that's selling there. And that's why it didn't push through a lot. It's just more of a technical kind of like squeeze thing going on there. And that tells you that, like, okay, the sell side is strong, and now you can lean on that area and go short. So the reason I bring up that latter part is because it's the flip side of the argument. Like, it looks like it's going to fail, but you don't really know. And then if you start to see how it prints afterwards, that tells you a lot about the quality of that failure.
Okay, and FT, this is for you. Why aggregate the big dot indicators versus showing individual executions tied to a single order? And that was on your other chart, your first one.
They are aggregated using MBO so that I can see what the demand side is. What the exchange reports is, a 200 lot lifted the offer in this case. What you will see on a regular platform is some snippet of 2 lots and 5 lots and 20 lots and 16 lots going across. With MBO, you can precisely re-aggregate that trade and figure out what got filled. And because this was a bit of a sweep here, it does it on a VWAP. It basically says, okay, we swept from, 39.38 to 39.39. We filled 20 and 20 at this. We filled 40 here, and we filled 11111, and it aggregates it and tells you what actually traded and about what price on a VWAP basis where that traded. So sometimes you get a dot outside of this. It's because it happened between the time that this footprint chart of a PNF 1/8 and this, and it just tells you about where it happened in terms of time and price. I want to see the aggregated. I don't want to see a whole bunch of little dots of what got filled. I want to see what was asked. You come into the market with 1,000 lot. I want to see somebody was aggressive enough to go to cross the market with 1,000 lot. I don't really care that 1,000 lot was filled with 1 lots 1,000 times. I don't really care about that. It's not really giving me that information. The CME changed the way it reports back in 2005 and overnight put, thousands of order flow scalpers out of business. By doing that, and with this MBO feed, you can recreate that. You can have that information again. Not that it matters, to be honest with you. It doesn't really matter. Do I care it's 145 versus 250s and a 45? I just care that somewhere around this price there was a collision there, and a fight took place, and the heaviest price that was traded in this bar is right here in the yellow dot. That's really what I'm looking for in terms of aggregated information. Okay.
That's great, and that's all the questions.
Excellent. Yeah, great stuff shared by Tendex here. Hopefully you guys picked up a little bit about icebergs and collisions so that when we're discussing them in the Head Trader channel, you have a better idea of what is being referred to. You're more than welcome to listen to this again and again to pick up the nuances as you monitor what's going on. And we'll catch you guys in the chat room. Thanks, Tendex, for sharing your wisdom, and Yoda for moderating. Take care.